Hi, everybody. Thanks so much for joining us today for the webinar. We have a big group today, so we're going to give people about 2 minutes to come into the room. So if you are here for LLC versus S Corp, you are in the right place. Just hang tight. I'll repeat myself one more time. So if you're just popping into the room, you are in the right place. We have a big group today, so we're going to give people about 2 minutes to come into the room. While we wait, I would love to hear from all of you who are already here in the chat. Where are you zooming in from and what type of business you have? So I know we have a lot of people flowing in right now, so I'm going to repeat myself one more time. If you're just coming in here, we're going to give people a few more minutes to hop into the room. But while we wait, I would love to hear from folks in the chat where you're zooming in from and what type of business you have. And we will get started in about a minute and a half. So let me know in the chat. Where are you zooming in from and what type of business do you have? We have such a quiet group. All right, here we go. I knew we'd get going. Courtney from Rhode Island owns a salon. Amazing. Diana is from California, is in construction landscaping. Bruno from San Diego, travel agency. Ramakrishna from Florida, looking to start a new business. Congratulations. Welcome to self-employment. Dipti from California, food business. Mark from New Jersey, RIA firm. I don't know what that is. Andrea, Atlanta, looking to start a new business as well. Oh, I love all these new business owners. It's so cool that you're like already learning the ropes of how to set up your business. Jacqueline from California owns a floral business. I'm taking a floral design class tonight, Jacqueline. Andrea owns a spa in Florida. Victoria, Stacy for Texas is a therapist. Mark is a financial advisor firm. Oh, got it. Kimberly from Washington is a mental health private practice. Barb zoomed in from Indiana looking to start a new business. I love this new business crew you got here. And Stacy from Roseville, Georgia is an accountant. Okay, we're going to start. I'll just do this last one. LaTanya from Detroit. I own a daycare. So let's hop in because we have a lot to cover and I want to make sure we have time to cover it. Thanks everybody everyone who told me where they were from in the chat. I'm just kind of moving all the Zoom screens over so I can get myself organized. All right, so let's talk about what we're going to cover today. We're going to do this overview, then we're going to talk about self-employed taxes 101. We'll talk a little bit more about LLC and S Corp basics, and then we'll get into the differences between the LLC and the S Corp. We'll talk about how to choose the right structure for you, how to get started, and then we'll have the live Q&A at the end, as well as our Amazon gift card giveaway. A few housekeeping items. First of all, I'd like to introduce myself now that we have the group here. My name is Andy Smiles. I am the Director of Content here at Collective. I will tell you a little bit more about Collective in just a moment. For the live Q&A, please put your questions in the Q&A box and not the chat. I'm going to repeat that. Please put your questions in the Q&A box and not the chat. The chat in these webinars can get very noisy, and it's quite difficult for me to keep track of what I've answered and what I haven't. The Q&A box has this amazing feature where I can mark off all the questions I've answered. So your question will not get answered if it's in the chat because I can't keep track of it. In the Q&A box, I can keep track of it. So before we get started, just a quick note from our legal team. This webinar is for educational purposes only. Nothing contained in this or any other related webinar should be viewed as legal or tax advice. Please always consider consulting a professional if you need legal or tax advice for your business. Now, before we hop in and talk about all things taxes, LLCs, and S Corps, I want to tell you just a little bit about your host today, which is Collective. We at Collective, we are the first all-in-one financial platform designed for self-employed people. Okay, so what does that actually mean? This is your money when you're self-employed. Basically, there's a lot of stuff you need to do and keep track of in order to run your financial back office. Everything from your taxes, your business setup, which is why you're here today, to your bookkeeping. And if you do payroll, also thinking about the future, like what should you do for retirement? And I maybe should look at a financial report sometimes. Things get even more confusing when you need to make a financial decision or at tax time, because suddenly you realize that all of these disparate parts of your business finances are connected. And this is when it can start to feel very chaotic, disorganized, and you can feel overwhelmed. So when I say that Collective is an all-in-one financial platform built for self-employed people, this is what I mean. We take all of these different parts of your business finances and bring them under one platform. But what's really cool about Collective is that we are not just software or a platform. We have a service aspect to our product as well. So you have a real live human working behind the scenes in your account, bookkeepers, accountants, tax preparers who specialize in self-employed finances. We'll talk more about Collective at the end, but I want to keep moving because, again, we have a lot of content to cover today. And I'm going to start with a poll. So Sarah, who's here helping me with the webinar, is going to launch a poll. And I want to hear from all of you. What are you struggling most with right now? Is it setting up your LLC or S Corp, your taxes? We are in tax season, your bookkeeping, finding ongoing financial advice, or retirements and benefits planning? All right, let's close out this poll and see what the people have to say. All right, 59% of you said setting up your LLC or S Corp. You were in the right place. 35% said taxes. I've got lots of information for you on that as well. 29% said bookkeeping. We can help you with that. 18 and 18, so this is a tie, said finding ongoing financial advice and retirements and benefits planning. We're going to talk about all of this stuff today. So anything that you're struggling with, we can help. I think my mouse may have just died. Nope. Give me 1 second, guys. All right. We're back. The mouse has returned. Okay, let's talk about taxes. And in particular, let's talk about the US tax system. So in the United States, there are two types of taxes that self-employed people pay. The first type of tax that you pay as a self-employed person is called income tax. And income tax is what you probably are already thinking of when you hear people say taxes or tax season or April 15th. In the United States, individuals pay between 0 and 37%, and this is based on your tax bracket. Now, the tax bracket system in the United States is really interesting. A lot of people hear that they're in a certain tax bracket. Let's say that someone has told you at some point you're in the 24% tax bracket. And you think, oh my gosh, does this mean I have to pay 24% on all of my income? The answer is no, because the US has what's called a progressive tax system. And what that means is that your income is taxed in chunks or tiers. So the first chunk of money that you earn may be taxed at 10%, the next chunk at 12, the next chunk at 15, the next chunk at 20, and that final chunk at 24%. So your tax bracket is not a flat rate of the tax that you pay on your income. It's actually the where you cap out in the percentage that you're going to pay. And what you are actually paying when you're paying your income tax is going to be the average of all of those percentages. So your income tax is not as straightforward as, oh, you're in the 24% tax bracket, you pay 24% on all of your income. And this is a good thing for us, right? Because what we're talking about here actually means that we're not paying our tax bracket in taxes, right? That's just where we're going to cap out. So that's a little bit about how income tax works. The next tax that self-employed people pay is self-employment tax. Now, this tax is different from income tax for a couple reasons. One, only self-employed people pay it. I think that's pretty obvious by the name. And two, this is a flat rate. So where income tax isn't a flat rate, self-employment tax is. So it is a flat rate of 15.3%. And self-employment tax is going to pay into your Social Security and your Medicare. Here's the thing. If you're an employee in the United States, you are still paying into your Social Security and Medicare, but it's happening in a slightly different way. Your employer is going to pay for half of those taxes. In other words, your employer is helping you out a bit. They're paying half of those Social Security and Medicare taxes, and you are paying the other half as the employee through a withholding from your paycheck. But when you're self-employed, the word self is in there. It's just you. There is no employer to foot that other half of the bill, which means you are responsible for that entire 15.3%. And this is why if you have gone from a more traditional employee job or W-2 job to being self-employed, you might be feeling like, wow, my taxes feel like they have doubled. And when it comes to these Social Security and Medicare taxes, they have doubled because now you are responsible for the whole pie. So let's look at this in another way, because I really want everybody to understand why your self-employed taxes can feel so expensive. So here's a situation where you owe $15,000 in Social Security and Medicare taxes. As an employee, you personally are only going to pay $7,500 of that. When you are self-employed, again, there is no employer to pick up the other half of that bill. You are responsible for the entire $15,000. So I hope seeing real numbers on the screen can help contextualize, again, why these taxes feel so expensive. Okay, we know now how you are taxed. Let's talk, or what taxes you pay. Let's talk about how you're taxed as a self-employed person. Here at the top, we have your revenue. Revenue is the money you earn for selling your goods and services before expenses and before taxes. It's just the money you're making from selling whatever you do in your business. Then you have your tax deductions. These are your expenses to operate your business. When we take all your revenue and we subtract your tax deductions, what's left is what's called net income. Now, if net income is a positive number, that is called profit. It means that you made more money than you spent. And if net income is a negative number, that is called a loss, and it means you spent more money than you made. Now, when you are self-employed, regardless of if you have a profit or a loss, that profit or loss is going to pass or flow through to your personal tax return. So that money, profit or loss, flows through to your personal tax return. And then you are going to pay self-employment tax, that 15.3% on most of your business profits. And then you will pay income tax. Now, income tax is not that straightforward. Income tax is assessed on your business profits, then any other income you have in your life. So if your business is a side hustle right now and you have another job, like maybe you have an employee job somewhere else, you're going to combine those incomes. Or maybe your business is your main hustle, but you are filing jointly with somebody else. You're going to combine your profits with that person's income. Basically, you're going to take your business profits and combine it with any other income you earn in your life, and then you'll subtract your personal adjustments and the standard or itemized deduction, depending on how you take that. What's left is called taxable personal income, and that is what you pay your income tax on. So I'm not showing you all the stuff around income tax because I expect you after this webinar to go calculate your own income tax. I know it's a lot of stuff. I'm showing it more to demonstrate how unique everyone's tax situation can be and why it's not as simple to just say, oh, this is how much your taxes are going to cost you, because there are all sorts of personal factors that really come into play with your income tax. The other key takeaway of this slide is that you are paying both of these taxes. So your tax bill is these two taxes combined. Okay, so why does this stuff matter? Because you came here to talk about LLCs and S Corps, and I just gave you a lesson on the US tax system. This stuff matters because how your tax is going to change whether you're an LLC or an S Corp. So we need to understand the baseline so we can understand what's going to be different. And with that, let's start talking about what's an LLC. Okay. Before we talk specifically about LLCs, we need to talk about the idea of a legal structure. A legal structure is a process that you go through to formally organize your business as its own entity. And usually this is formed in a state with your Secretary of State. So two types of legal structures you have probably heard of are the LLC and corporations. When you become a legal structure or set up a legal structure for your business, as I mentioned, you are going to file organizational paperwork, formally organizing your business with your state. And part of being a legal structure means that you're often required to file annual reports about your business, and you may even have to pay a fee. And this is all happening with another state agency. Typically, it's going to be your Secretary of State, but sometimes it changes state to state. The main thing here to know is that if you have a legal structure, you're going to have more paperwork, and you are going to be interacting with new state agencies. So what happens if you don't have a legal structure? If you don't have a legal structure and you've never formally organized your business with the state, you're what's called a sole proprietor, and there's nothing that you need to do. This is going to happen by default as soon as you start earning self-employed income. As a sole proprietor, under the eyes of the law, you and your business are considered one. So under the eyes of the law, there is no separation between your business and your personal assets. They are all considered one. Even if you have your money in like a personal bank account and a business bank account, we're talking about the way that the law sees you as a sole proprietor. So as a sole proprietor, you and your business are one. All of your assets are seen as one under the eyes of the law, and your business profits are passed on to you, the individual. That flow chart I showed you earlier about how you're taxed, that is how you are taxed as a sole proprietor. And as a sole proprietor, you don't need to file an annual return with your state. You just sort of get to exist and then do your taxes. Okay, so let's talk about the LLC. So an LLC, as I mentioned earlier, is a type of legal structure. This means that it is going to require registration with your state and going through that formal formation process. You'll also have to do some sort of ongoing state reporting and sometimes even pay annual state fees. Now, one of the main benefits of the LLC is that it gives you what's called limited liability protection. And here's what that means. So earlier I said, as a sole proprietor, under the eyes of the law, you and your business are one. Your assets are considered one. As an LLC, under the eyes of the law, you and your business are separate. That means that your personal assets belong to you personally. Your business assets belong to the business. If your business is sued or has creditors coming to collect debts, your LLC will create a legal shield between the business and your personal assets. And that legal shield, in most cases, can't be pierced. So what happens is that your personal assets are going to be protected from business lawsuits and creditors. That means things like your house, your car, your retirement savings, your personal savings. All of that is protected and separated from the business. And this is one of the primary reasons people start LLCs, because it enables them to protect their personal assets. But there are a few other benefits to LLCs. First, it can lend credibility to your business. Before working at Collective, I was a small business financial consultant for 11 years, and I worked with clients who often had to start LLCs in order to sign contracts with really big name clients, like the types of clients that if I said their name, you would know them instantaneously, household names. A lot of larger corporations and companies want to contract with an LLC, not a sole proprietor, because of that issue with liability. So sometimes it can lend more credibility to your business and also just open up doors in terms of the types of clients you can serve. It also allows for multiple members, which is just LLC speak for owners. So as a sole proprietor, you have the word sole in there. You are the only one who can own your business. As a LLC, you can have multiple owners. And finally, one other important thing to know about LLC is that those business profits are passed through to you, the owner. Remember that flow chart I showed you earlier? That is how you are taxed as an LLC. And that is because an LLC is taxed like a sole proprietorship. So by default, how you are taxed as an LLC is the exact same way that you are taxed as a sole proprietor. This is a very, very common mistake. that I see people making. They will start an LLC and think that by the nature of the LLC, their tax situation is going to change. So they start their LLC, go through their year, they file taxes the next year, and nothing has changed about their tax situation. The reason for this is because how you are taxed never changed. You just started enjoying those legal benefits, that liability protection that the LLC affords you. But an LLC can change the way it's taxed. And we're going to talk about that in just a moment. But before we do, I want to talk a little bit and recap on the differences between the sole proprietor and the LLC. So the LLC will require registration with your state. You will not need to do that as a sole proprietor. And remember that LLC creates that legal shield between your business and your personal assets. That is not something that you will have as a sole proprietor. And the LLC can have multiple owners. Now, with both the sole proprietor and the LLC, those business profits are going to be passed through to the owner's tax return, and you are paying self-employment tax on the profit. This is because, remember, an LLC and a sole proprietor are taxed the exact same way. Now, there's one other key difference that I kind of touched on earlier about the LLC, which is that an LLC can change the way it's taxed. It's called tax flexibility. And that, my friends, is going to bring us to the S Corp. So, fun fact, an S Corp is not a legal structure. An S Corp is a tax election. I know that when we talk about S Corps, we say things like, I'm an S Corp, or I want to become an S Corp. Even the name of this webinar is LLC versus S Corp. But technically what's really happening when you are an S Corp is that your LLC is electing to be taxed as an S Corp. So if we were to use the most technically accurate terms for this webinar would be called LLC not taxed as an S Corp versus LLC taxed as an S Corp. Obviously, that one is not going to fit on our marketing materials. And two, you probably wouldn't come to a webinar called that because it's very confusing. But in essence, what's happening when you are an S Corp is you are still an LLC. You are an LLC with a S Corp tax election. It is not an either or situation. So another way I like to think about it is think about like building a house. What do you do when you first build a house? You lay the foundation. Your legal structure, like your LLC, is the foundation. Then the S Corp is the tax house that you're building on top of that foundation. But that foundation is always going to remain there. You will always still keep the LLC and all the liability benefits that come with the LLC. So with the S Corp, you are essentially asking the IRS to change the way your LLC is taxed. You're saying to the IRS, I don't want to be taxed the same way the sole proprietorship is taxed. That's what you're doing to me by default. I want to be taxed under the rules of the S Corp. And the IRS can say, great, then you get to be an S Corp. So why would we want to do this? Why would anyone want to change the way they're taxed? Well, one of the primary benefits of S Corp taxation is that S Corp owners don't pay self-employment tax on their business profits. Remember, that's that 15.3% tax that's paying into your Social Security and your Medicare. What is going to happen is that the S Corp will create an employee and employer relationship between you and your entity. It is kind of meta. You have to sort of like think about yourself and split yourself into two. There is the employer S Corp you that is employing the personal you. You are becoming an employee of your own business. And your business is required to pay you what's called reasonable compensation through payroll. In other words, you are going to get a paycheck from your business. And the good thing is your salary becomes a business expense. Now, here's the deal. You're treated like any other employee, which means that your employee wages are subject to payroll tax, which is 15.3%. I know it's the same thing as self-employment tax, and it's doing the exact same thing. It's paying into your Social Security and Medicare, but only your employee wages are subject to that 15.3%, not the profits. And half of those payroll taxes will be withheld from your paycheck, and the other half become an expense for the S Corp because you are the employer. It's an employer payroll expense. Let's look at this. Let's look at how this works. So this is just a quick reminder. We're not going to go back over it. This is just a reminder of how you are taxed as a sole proprietor and LLC. Now let's talk about how you're taxed as an S Corp. Here at the top, we have your S Corp revenue. Remember, this is the money you earn before expenses and taxes. Then we have your operating expenses, just what you need to spend to run your business, and your owner's salary. Your owner's salary is an expense of your business. And then we have those 15.3% payroll taxes. Now, what we're going to do is we're going to take the S Corp revenue. We will subtract our expenses. We will subtract our salary. We are going to subtract half of those payroll taxes. What's left is your S Corp profit or loss. And that profit or loss is going to pass or flow through to your owner tax return as well as your salary. So you're going to report your business profits and the salary you receive, right? Because you're an employer, you get a W-2, just like any other employer job. And then you are only paying income tax on the salary and the profits. And of course, all the other stuff that comes along with income tax. So a couple things I want to point out about this slide. First, where once we had 2 tax boxes at the bottom, we only have 1. And we're going to look at something next that breaks down the numbers a bit more. 2, with S Corp taxation, you are avoiding what's commonly known as double taxation, which happens with corporations. Because in S Corp, it's what's called a pass-through entity or a pass-through tax structure. And as the pass-through tax structure, you do not have to pay taxes at the business level and then again at the personal level. Everything's just flowing down to the personal level. So what we love about S Corps is that there is no double taxation. Let's look at how the tax savings actually breaks down in practice. Here's an example of someone who is a sole proprietorship or a single member LLC without the S Corp tax election and an LLC tax as an S Corp, which I will call an S Corp because I can't say LLC tax as an S Corp. This webinar will be like 3 hours long. So we have the profit. This person is earning $160,000 in profit. Then that S Corp owner is going to pay themselves a wage. You can't do that as a sole proprietorship or the LLC without the S Corp tax election. You can only do that with S Corp. The amount of money that is subject to those Social Security and Medicare taxes, that's at 15.3%, changes. For the sole proprietor, it's $160,000 subject to those taxes. For the S Corp, it's only $60,000. This is the key to the S Corp tax savings. Basically, you have less money subject to Social Security and Medicare taxes. And then it becomes just a mathematical exercise, right? So with the sole proprietor, the taxes are about $15,000 more than the S Corp because there's more money that's subject to those Social Security and Medicare taxes. So in this example, there's about a $15,000 tax savings. But let's talk about the last 2 lines, because I actually think the last 2 lines are where things get really interesting. What is the profit that's passing through to your owner tax return? Well, for the sole proprietor, it's just all of it, right? It's all just getting passed through to the owner tax return. For the S Corp, it's $100,000. Why is it not $160,000? Because your owner wage is a tax deduction. That is going to lower your overall profit. But let's look at the taxable personal income. Why are they the same? Because the owner wage is still income that you're earning. You will be reporting that on your tax return. So the TLDR is you save a lot of money in taxes and you're earning about the same amount of money as well. Okay, so this is the point of the webinar where people get really excited and 2 questions come up. You keep talking about you paying yourself. How much do I pay myself? And what happens if I don't pay myself? Because then I don't have to pay any taxes. So let's talk about it. First of all, I keep using the word reasonable compensation because that is what the IRS calls it. And unfortunately, there is no set standard for reasonable compensation. It is a facts and circumstances argument. This means that you cannot go on the IRS website and type in Reasonable compensation for a marketing consultant in California. It is not going to give you that. So you really need to work with collective or a tax professional to help you pick this number. And the reason for this is that your salary is a tax strategy. I'm going to repeat this. Your salary is a tax strategy. It is not about how much you want to get paid from your business. It is not about what you think would be really cool to get as a paycheck from your business. It's not even really about what you need to get paid from your business. We will talk about how to get other money out of your business for your personal expenses later. It is a tax strategy. So what you are trying to do with your reasonable compensation is strike a balance between having tax savings and being within the rules of the IRS, right? The IRS has given us this great tax selection. It's wonderful for small business owners. We want to respect the rules. So I love this image because I think it does a good job of showcasing what you're targeting. So let's say that you were to take this little image here and you were to slide that slider all the way up to the top and pay all of your expected profits out in your annual salary. Well, the IRS would love you. You'd have excellent defensibility, but you'd have zero tax savings because you're just replicating the tax structure of the sole proprietorship, where all the taxes are subject to Social Security and Medicare tax, or all the profits. Now, let's say you did the opposite. Let's say you slid this all the way down to zero. Well, yeah, your tax savings would go through the roof, but the IRS would not be very happy with you because you are required to pay yourself a reasonable compensation. So you're really trying to stay in this range of this is defensible to the IRS, it makes sense for you and your business, and you are still leveraging the S Corp tax structure and saving on your taxes. Okay, so let's talk a little bit more about some additional benefits, because usually when people talk about S Corps, they really focus on talking about the tax savings, but there are some other benefits for you. First of all, when you are an S Corp, there are more tax deductions. We've already talked about some of these, right? We've talked about the your salary being a tax deduction. We talked about half of your payroll taxes being a tax deduction. This is going to lower your profit and help you save on other taxes like your income tax. The other cool thing about the S Corp is that there are higher retirement contribution limits. As an S Corp owner, you can start what's called a solo 401k. And with a solo 401k, you can contribute as an employee and as an employer. Now, the employee contributions work the same way as any other 401k contribution. The employer contributions are where they get interesting, because you can pay into your own solo 401k as an employer, and those contributions become a tax deductible expense of the business. That ties back to number one. But the other thing is both the employee and employer contributions have different contribution limits. So they have different limits that they're allowed to contribute. And when you combine these two limits, and if you were to max them out, you can usually contribute more in a year than you can through other retirement accounts. This is why there can be some really cool retirement benefits with an S Corp. And this is one of those things that people don't talk about as much, but I've talked to many S Corp owners who have said that this is one of their favorite parts. Okay, the last thing that is a benefit of the S Corp is something that's called an accountable plan. Now, remember, as an owner of an S Corp, you are an employee of your own business. And the accountable plan is basically an agreement between an employer, your business, and an employee, you, that the business will reimburse you for personal expenses. Now, it's important to understand that this is a reimbursement, not a fringe benefit, which means reimbursements are not taxed. So unlike a fringe benefit, which has to be reported, a reimbursement is simply a reimbursement. So what can happen is that your S Corp will actually reimburse you, the employee, for things like the use of your home office, the use of your personal car, the use of your personal cell phone, the use of your home internet, so on and so forth. And this is real cash. This is like actual money that is going from your S Corp. So let's say all of these expenses add up to $500 a month. This is going from your business to you in a tax-free manner. And then your business gets to write off that reimbursement on its own profit and loss. So the business is still taking these as expenses. You're not losing the deductibility of any of these things, but instead you're just getting a cash reimbursement, which can be really cool. So let's talk about how you get paid from your business, because earlier I said something that may have scared you, which is that your S Corp salary really has nothing to do with what you need to live off of. It is a tax strategy. Here is how you supplement that. So there are 3 ways you get money out of your S Corp. The first one, salary. We've talked about this. The next one is a distribution. You can take money out of your business for personal use anytime you want. This is simply just transferring money from your business account to your personal account. So when I was self-employed, I had an S Corp. What I did is on the first of every month, my payroll ran and I had direct deposit for my paycheck, for my salary. But that wasn't enough. This is how much I need to live off of. And this is what my salary was, because my salary was a tax strategy. So then I took a distribution. So there was an automatic transfer on the first of every month that made up that difference. So I was still benefiting from the salary, but I had enough to live off of. This is very, very common. People just take distributions to supplement whatever their salary isn't covering. And then the last part is the reimbursed expenses. Remember, this is actual cash you get out of your business every month. And if you live in a high cost of living area and you're doing, like, you have a home office space, this can add up to quite a bit of money. So this is how you can get paid from your S Corp. Okay, let's talk about the differences between an LLC and an S Corp. And remember, when we say LLC, we mean an LLC that is not being taxed as an S Corp. And when we say S Corp, we mean an LLC taxed as an S Corp. So both the LLC and the S Corp have that legal shield between their business and personal assets. You still get that liability protection. Why? Because an S Corp is still an LLC. An S Corp is just a tax election for your LLC. So you still get to have all of that liability protection. With both LLC and an LLC tax as an S Corp, the business profits are going to pass through to the owner. But only an LLC with the default tax treatment will pay self-employment tax on the profits. An S Corp doesn't have self-employment tax. With both, you're going to have income tax. Sorry, we can't make that one go away. With the S Corp, the owner can pay themselves through reasonable compensation and employee wage. With both the LLC and an LLC tax as an S Corp, the owner can pay themselves through draws or distributions. They are different words. They mean the exact same thing. Just depending on your tax structure is what word you use. I know we don't make it easy in the accounting world. Basically, you can pay yourself through a draw distribution with both. Now, the other key difference about the S Corp is that the business is going to file its own tax return. So this is important to know, that there is going to be a little bit more tax responsibility on you if you decide to have the S Corp tax election. Okay, so the moment you all have been waiting for. How do I know if I should do this? When do I know I should think about being an S Corp? Who should be the S Corp, right? Like, what am I supposed to do with all this information? Okay, let's talk about it. An LLC or sole proprietorship is best for those who, one, are new to business with very little earnings. If you are not earning any money, if your business is taking a loss, it is not the right time for you to elect for S Corp tax treatment. Just give your business some time. The internal guideline we use here at Collective is if you are earning less than $60,000 in self-employed profit per year, then it's really not time yet for the S Corp. Why is it $60,000? Because an S Corp requires more tax and accounting complexity and responsibility and paperwork. You will need to pay for extra things with the S Corp. There is a point where all the other things you're going to have to pay for, like an additional tax return, maybe bookkeeping support, payroll software, bookkeeping software, all of the additional things you're going to need to pay for will not outweigh the tax savings that you get. It's basically going to be a wash, and you're not going to feel the benefits, and you're just going to have more responsibility. But when you hit that $60,000 profit threshold, this is where you will begin to really feel those tax savings, even if you have all of these other complexities that you have to invest in. So this is why it's $60,000. This is the guideline that Collective uses. This is not the IRS rule. The IRS doesn't care, but this is where we see the S Corp being most beneficial to people without causing too much additional back office burden. An LLC or sole proprietorship is also good for folks that are just like, this sounds complicated and I don't want to deal with all this. Like if you're hearing me talk about running payroll for yourself and another tax return and you're like, oh, I don't want to do any of that stuff, then it may not be a good fit for you. So let's talk about who the S Corp is right for. An S Corp is best for those who, as we've already discussed, are earning more than $60,000 in self-employed profit per year. Remember, profit is after expenses. Revenue minus expenses. If there's money left, that's profit. It's also good for folks who want to maximize their retirement savings. So if you're somebody who was like me when I was self-employed and didn't save anything for retirement, and you're finally in a place where you're like, yeah, I really need to think about that stuff, this can be a really great way to catch up on your retirement contributions. And it is also good for folks who have enough cash flow to make regular payroll runs. Here's the deal. Do you need to make a payroll run every single month required by law? No. Really what the IRS is going to look at is your annual salary. But you do not want to find yourself in a situation where it's December and you have not run any payroll. And in order to be in compliance, you have to run a $60,000 payroll run. Where are you going to get the cash for that? So it tends to be more manageable for folks to have regular payroll every month to spread that out, and you need the cash flow to sustain that. Okay, so let's talk about getting an S Corp set up and operating the S Corp. Okay, so first, how do you get one of these babies set up? Like, okay, you're like, this sounds cool, I want to do it. How? The first thing is you need to create an LLC. If you are a sole proprietorship, you cannot ask the IRS to tax you as an S Corp. You do not have the right to change the way you are taxed. You will need to form an LLC that gives you the right to ask the IRS to change the way that you're taxed. So how do you form an LLC? You'll need to file formation paperwork like your articles of organization, usually with your Secretary of State. And you'll want to file any other state required paperwork. Remember, LLCs are set up under your state. So every state is going to have a slightly different process. And then you'll want to ensure you have an LLC operating agreement in place. Then you're going to have your S election. This is where you're going to ask the IRS to tax you as the S Corp. Before you can actually file that paperwork, though, you need to get an employer identification number or an EIN through the IRS. Then you will file the paperwork to file the S election. And then finally, you need to register for a payroll account because you now are going to become an employer. And there is a surprising amount of paperwork that comes along with registering for a payroll account. Next, you are going to set up your tools to assist you with your S Corp management. That's first going to look like a bookkeeping tool. You do need to have some kind of bookkeeping tool in place. A shoebox full of receipts will not cut it anymore. And a payroll tool. People ask in every webinar, why can't I just DIY my payroll? You can DIY your payroll. You certainly have the freedom to do that. Should you DIY your payroll, and how much time is that going to cost you and potential money in errors? No. Payroll is extremely complex. There's a lot of tax tables. There's a lot of money you have to withhold. It's a lot of math. And you also have to file quarterly payroll tax returns with various agencies. It's a lot of paperwork. To do it yourself is a lot to take on when you're trying to run a business. But there's great tools out there like Collective. Gusto is another good option that can support you with your payroll needs. And then you're going to set up your money flows. So you want to be sure that your business bank account and business credit card are all set up under the LLC and that EIN number. It all needs to tie back to the LLC to protect your liability protection. And you'll also want to ensure that you're changing over everything to that LLC. So this is getting set up. Let's talk about the ongoing operations. On an ongoing basis, you're going to need to file business and personal tax returns because remember, the S Corp has its own business tax return. You're also going to need to file those payroll returns that we just talked about, which is why we like the is why we like payroll software. And you'll need to maintain the entity. So this looks like filing state paperwork on an ongoing basis as required by your state. That could be annual, biennial, sometimes every 3 years. You may need to pay annual fees. And then you also need to keep up with your books and tax obligations. This is going to be maintaining your bookkeeping monthly, and then also paying estimated taxes quarterly for federal and state. So S Corp owners still have to pay estimated quarterly taxes on their expected business profit. So you're not off the hook for those quarterly taxes. Okay, we are going to launch a poll. But before we do, we are going to do our Amazon gift card giveaway. So Sarah, let us know who the winner is. And maybe if you want to launch the last poll, we can also do that while you're pulling the winner. But somebody here will win a $50 gift certificate to Amazon. All right, so while Sarah's pulling up the giveaway winner, are you thinking about switching to an S Corp? Let us know. Yes, you're in, not just yet, and I'm still not sure. I'm going to take a very much needed sip of tea. All right, and I think we can close out the poll. Okay, so 22% of you say, yes, I'm in. That's awesome. We're going to talk a bit about how we can help. 55% of you say not just yet. That's great. You know, the whole point of this is to be extremely intentional about your business. And so if you're like, this is not the right time for me, great. Walk away with this knowing when you need to think about this again and when you need to make those considerations. 23% of you say, I'm still not sure. I have a resource to help you get more sure. And Sarah just put the name of the winner in the chat. Melissa Cobb, you have won a $50 Amazon gift card through our giveaway. Congratulations. We will be sending this to you afterwards. Thanks so much for joining us. Okay, so I want to move on to talk a little bit about how Collective can help. Okay, so this is what it's like to have an S Corp without Collective. So it looks a little bit different than the one I showed you earlier because this one is S Corp specific. And now we have things like setting up your S Corp, calculating your reasonable salary, that S Corp tax return, all the accountable plan, all of these nuances to S Corps. And this is what it can look like. It can be kind of overwhelming. This is your S Corp finances with Collective. We specialize in S Corps for self-employed people. So I always kind of call us, it sounds cheesy, but I call us like the S Corp people because we know so much about S Corps. And as I mentioned earlier, with Collective, we are a platform. We're an all-in-one platform where all of these different parts of your business finances can live. But we also have a team of financial experts and S Corp experts working behind the scenes, doing your bookkeeping, your taxes, your S Corp accounting, and also there to support you with any questions you may have about your business finances, like your tax deductions. So we are this really amazing, I always call it people power technology, because we have this great platform where you can run payroll, where you can see your expenses and income in real time, and you can pull financial reports, but you don't have to do all of the heavy lifting and the work. And again, we specialize in S Corps, so we really know how to maximize your S Corp tax deductions and, you know, how to file the S Corp tax return efficiently and all of that good stuff. Collective is available nationwide, and we work with sole proprietors. So if you do not have an LLC set up already, we will set one up for you. We also work with LLCs. So if you're watching this and you're thinking, wow, like I should be an S Corp and I'm an LLC right now, we can help you get your S Corp set up. And we also work with existing LLC or existing S Corps. So if you're watching this and you are an S Corp and you're like, I'm not doing any of this. Like I did not do any of these things. We can help. We exclusively work with people who earn $60,000 or more in self-employment profits. Why? Because this is not like an Oprah moment of like, you get an S Corp and you get an S Corp and you get an S Corp. It's really important to us that people who are going to benefit from this tax structure have it, and that people who aren't going to benefit from it aren't involving themselves with it yet. Because again, there is more complexity. There is more risk for, being out of compliance. We really want to ensure that it's the right fit for people. So we exclusively work with folks who earn over $60,000 in self-employed profit. Okay, so what does Collective do? Well, we start with forming your LLC and filing your S Corp tax election. So again, if you do not have an LLC, we will form that for you in your state. If you already have one, we will first ensure that it's in good standing with the state, clean, neat, all the I's are dotted, the T's are crossed. And then we will go through the process of obtaining that S Corp tax election for you and working with you on reasonable compensation guidance. Collective includes monthly bookkeeping as well as bookkeeping tools and payroll tools. So we will help you get set up with the bookkeeping tool. So, show you how do you pull reports when you want to see them, or how do you look at your expenses? Even though we are doing the actual bookkeeping work, it's important to us that you have that financial visibility and that you can go in and see what's going on in your business at any time. We also have a payroll tool embedded in our platform, so you do not need to pay for a separate tool like Gusto. Everything is in our platform. And then we'll register you as an employer. And then you move into the ongoing back office support, which includes monthly bookkeeping. So no more spreadsheets, no more logging into QuickBooks Online, trying to figure out what something is supposed to be categorized as or why your bank isn't syncing. We do the monthly bookkeeping for you, as well as all the S Corp specific accounting. We also have tools to support you with the accountable plan, and we send you compliance reminders to help ensure that you are keeping up with your entity compliance needs. And at Collective, as I've mentioned several times before, it's real people. Like it's not just software. We have a really cool platform, but we also have real live human beings that you can message at any time with questions. So if you have a question, or let's say you get a notice from the IRS and you don't know what it means, there's somebody here that can answer those questions for you. And then finally, we take care of your taxes. That does include that S Corp annual business tax return on the federal and state level, but it also includes estimated tax calculations and reminders, because taxes are not one time a year, they are 4 times a year. So every quarter we calculate what your estimated taxes will be, and we send you a notice saying you got to go pay X amount of dollars to California. Here's a reminder of how to do that so that you are staying on track with your quarterly taxes. Collective costs just $349 a month, and there is a one-time onboarding fee. There's also an annual plan where you can save a little bit of money. And remember, this includes monthly bookkeeping and payroll tools. So with Collective, you don't need to pay for QuickBooks. You don't need to pay for invoicing software. You don't need to pay for Gusto or other payroll tools. Everything is inclusive, including those tax returns and that monthly bookkeeping service. And Collective is tax deductible. Okay, so we want to invite everybody to schedule a call with our tax advisors. So we have a team of tax advisors that you can schedule a 20-minute call with. Sarah has just put the link in the chat. I'm going to click on it. Here we go. So when you click on this link, you will be taken here. You can go ahead and fill out this form. If you are a good fit for Collective, it will push you to schedule a call. If it's not quite clear to us, if you aren't, we're actually going to take your information and have somebody review it to see if you are going to be a good fit or not. Sometimes we have to do a little bit more investigation. So in either case, we invite you to schedule a call with a Collective tax advisor. It's a free 20-minute call. And this is the place where you can talk about your unique business. what your situation is and get a better sense if collective and the S Corp is right for you. So, for example, if you were one of those people that said, yes, I'm in, you should schedule a call and see how we can help you get your S Corp set up. If you were one of those people that were like, I don't really know, I'm still not sure, maybe you have some unique things in your business that you're just not quite sure how that would all work out here, you should schedule a call. And if you're one of those people that said not just yet, don't schedule a call now if you don't feel like this is a good fit for your business, but keep us in mind because you never know how quickly you can get to that 60K mark. Okay, so I am going to switch over to the Q&A and answer. I see. Okay. Yeah, I'm going to answer the Q&A questions. So just going to the top, Carmen asked, will you email us the PowerPoint? We will not email you the slides, but you will receive a replay link. So you can watch it as many times as you need to. And obviously it's video, so you'll be able to see the slides over and over again. All right, Anonymous asked, would S Corp be used if you have a nonprofit component in your LLC, or would you need to create a separate legal structure? So if you have a nonprofit component in your LLC, I mean, usually it works the other way around where there is a like 501c3 nonprofit that has some sort of non-programmatic revenue generating activities that they report. So I'm not really sure about this. I've never heard about someone with an LLC with a nonprofit component, unless you have a fiscal sponsor, maybe. I'm sorry, Anonymous. I don't think I can answer this question because it's too nuanced. I need more information on this. Luis, does it matter how you file your taxes combined with your personal taxes, having an LLC from protection to your assets standpoint? Does it matter how you file your taxes combined with your personal taxes, having an LLC from protection to your asset standpoint? Is it recommended to file taxes for LLC separate from your personal taxes? Great question, Luis. So actually, if you are an LLC and you do not have the default S Corp tax treatment, you are required to file your LLC, like your business information with your personal tax return. So remember, your business from a tax perspective is just going to pass the profits or losses onto you personally. It is not like a corporation or a C Corp structure where the entity itself is filing its own tax returns and is being taxed at the business level. The entity is not taxed at all. Your LLC isn't taxed. It is all being passed on to you, the owner, and that pass-through profit is going to be reported on your personal tax return. So you actually don't really get a choice in the matter. You have to file your profits with your personal tax return on the Schedule C. That is how you are required to file your taxes. But I think the question is really more like, is this going to impact my personal liability if my tax return is reporting those profits? And the answer is no, because that entity is just passing through to you. So it doesn't impact your liability protection to, report your business profits on your personal tax return. And it's actually the way that you are required to do your taxes. Diana, what about a partnership versus an S Corp? So a partnership so the way a partnership is taxed is similar to this chart here. Oops. What just happened? There we go. The key difference is that instead of the profit being passed on to one person's tax return, it's passed on to the two people's tax returns, right? The partners, or you have multiple people, right? So let's say you had $100,000 in profit that would and you are 50-50 partners. $50,000 is being passed on to owner A and $50,000 is being passed on to owner B. And then what's happening here at the bottom, the self-employment tax, the income tax, that is all the same. So that's how a partnership is taxed. Now, if you were a multi-member LLC, with an S Corp tax election, because that's really what we're talking about here. You would be a multi-member LLC, so an LLC with multiple owners with the S Corp tax election. If that were the case, then you would still be taxed. Now we got to get this guy back up here. You would still be taxed like this. However, you would have two reasonable salaries, right? So there would be reasonable salary for a partner A and reasonable salary for partner B. And then the pass-through profit or loss would be the same. So it's what percentage of ownership does each person have? And then that profit is going to get split between the two owners. And then their salaries will be reported on the respective tax returns. Where things get tricky with the partnership or the multi-member LLC is that, I'm just trying to get back to this slide, is that you will need some help from a tax professional determining reasonable compensation for each partner. And that $60,000 threshold I gave you is not going to apply, because now you have to think about the fact that you have two people who are earning that reasonable compensation. You're thinking about two different tax scenarios. So partnerships or multi-member LLCs are definitely more complicated in terms of figuring out if the S Corp tax election is a right fit, because there are more nuances and considerations. So you would want to talk with a tax advisor about that. Bruno asks, if I have employees, do I still have to pay myself? Yes, if you have an S Corp tax election and you have employees, you still need to pay yourself. It does not matter if you have 100 employees or zero other employees. If you are an owner employee of the business and you are profiting, you need to pay yourself from your S Corp. Anonymous, how do you determine salary when the business has variable profit? This is a great question. So it is somewhat in part based on your profit. And what I mean by that is that if your business is profiting $100,000 and you pay yourself $1,000 in salary, that is like very out of proportion. But it is not only on salary. You want to think about not only on profit. You want to think about other things like, where do you live, right? Your geographic region. What other people in comparable roles will be paid? Now, this one is a little tricky because this is where it kind of comes back to that profit piece. Let's say your business profits $100,000, but someone in your comparable role would be paid $150,000. You're not going to pay yourself $150,000. You're not going to pay yourself more than your business profits, because from like a business standpoint, that doesn't make sense. So it's a little finagly because profit plays a role, but there are other factors, your trainings, your certifications. Another big factor is how much of your time goes towards revenue generating activities in the business. Do you have a business that's service-based and you are like doing all the work to generate the revenue? Well, that's going to be like more of your time. Do you have a business that is like completely passive and you basically aren't doing anything anymore? Then your reasonable salary might be different. So again, this is why it's important to have guidance from a tax professional or someone like Collective that specializes in S Corps, because profit is like a good like leading indicator, but it is not the only indicator. You still need to think about it holistically. Amanda, what if I've had a really great month? Do I give myself bonuses to access that money? Yeah, you can do it okay. You can give yourself a bonus through a distribution. I think if you have a great month, you do want to be thinking about your salary adapting to what's going on in your business. So let's say you start your year and you think you're going to earn $100,000. So you're like, great, I'm going to pay myself $50,000 in reasonable compensation. And then you earn $300,000. Your reasonable compensation does need to go up, right? You do need to think about the fact that like your salary should be inflating or deflating a bit with how your business is doing. Now, if you thought you're going to earn 100 and you earned 105, you don't need to make those adjustments. But I'm talking about like, I thought I was going to earn 100, I earned 300. That's 3 times as much. My salary needs to go up. Same thing with if you're under earning. So let's say you went into a year thinking you're going to make 100. You're like, great, I'm going to pay myself $50,000. and you're at the end of the year and you made 60. It doesn't make sense to pay yourself $50,000. So there is some kind of like ebb and flow that you need to have with the salary. And this is why bookkeeping becomes so much more important, having access to those financial reports where you can look and see, what have I profited year to date? Am I really on track with my salary? Am I underpaying myself or overpaying myself? Because that can happen too. You can make less than you expect, overpay yourself, and then you're losing tax savings benefits. It's something people don't think about when they think about bookkeeping services. They're like, oh, it just makes me more organized. But actually, just knowing that your reasonable compensation isn't over, like you're not overpaying yourself, that can save you money on taxes and probably pays for the service itself. Diana, what about workers' comp insurance going up based on wages owners pay themselves? Workers' comp is really tricky because it's a state by state thing. So I can't really speak much to workers' comp because every state handles worker comp requirements differently. That said, I would my kind of like high level point of view on this is that what you save in the S Corp tax savings is probably going to outweigh whatever increase you have in workers' comp. If you are required, some states don't require single owner businesses to have workers' comp, some do. This is why it's complicated, it's state by state. But, you know, if you're paying an extra $200 or $300 a year in workers' comp, but saving $15,000 on taxes, it's like not a comparable, like you just pay $300 in workers' comp. Plus, then you're covered. That's good news too, right? I mean, like then it also gives you some security. It's not all bad. Latanya, hello. If I currently have an LLC with an EIN, do I need to create another LLC and obtain a new EIN, or can I just make an S Corp election with my current business? You do not need a new LLC. You can just make your current LLC the S Corp, and it can all be under the existing EIN. Because remember, all we're doing is asking that the LLC that we have, whether it's brand new or one that we've been running for 10 years, all we're doing is asking for that LLC to be taxed differently. So you do not need to go through a whole new formation process. You can certainly retain your existing LLC. Amanda, how easy is it to switch to S Corp structure from LLC? It's relatively easy in the sense of, you know, you don't have to like go to court argue your case for it. It's paperwork. So how you think about is paperwork easy or hard for you? I think that's like a personal thing, but it's essentially paperwork that you're going to file with the IRS. Sue-Ann, can you start out as an LLC and later add the S Corp? You absolutely can do that. If you are watch this and you're like, I love the idea of the liability protection, like I need that. It makes me feel more secure, but I'm not making that 60K yet. Start an LLC, and then you can elect to be taxed at the S Corp at any point in time. That is absolutely fine. And actually, when you have an LLC, it gives you more flexibility to adapt when you're ready for the S Corp tax election. I cannot tell you how often when I was consulting, I would talk to people who, you know, their business is kind of like trucking along, and then in 3 months, they just like grow exponentially. And it happens so fast. Like sometimes business growth can happen so fast and you're not prepared for it. You didn't plan for it. It just happens. And so with having an existing LLC, when something like that happens, you can be like, great, I know now I'm hitting that mark. I want to save on my taxes next year. I'm going to elect S Corp tax status. When you don't have a current LLC, well, you can still elect for the S Corp tax status, but you have a whole bunch of other things you need to do first. You need to set up the LLC. You have to go through all that paperwork process. Then you need to go through the paperwork process for the S election. And with the S election, like the S Corp tax election, you can actually backdate it 75 days. So you'd even get even more tax savings out of having that LLC. You can't do that if you have a brand new LLC. So there's a lot of benefits, especially if the liability protection is really like juicy, like exciting for you. There's a lot of benefits of just having in the LLC and then electing to be taxed as an S Corp when you're ready. Will there be a replay opportunity for this webinar? Yes, we will send out the replay within 24 hours. Anonymous, what if you have a 10% partnership LLC? Okay, so if you have a 10% partner, everything I said earlier is the same. It's just that that partner is getting 10% of the profits, not 100 or 50. So if it was 100,000, they're getting 10. But again, you still need to talk to a tax person or a professional about the S Corp. Because if you have a 10% partner, there needs to be a discussion of, is this a silent partner? Are they doing anything for revenue generating activities? Do they need a reasonable compensation? And that's not questions that like I can just answer on a webinar. It's something that you need to meet with somebody who has expertise in S Corps and laws around reasonable compensation, because it could be that that partner doesn't need to get paid reasonable compensation because they're not contributing at all to the revenue generating activities. Maybe they just made a capital contribution. But again, it's nuanced, and you need to talk to somebody who can really dig into your unique situation with you. Tina, does Collective work with other software? I have a healthcare business with Power Diary software. I'm not quite sure what Power Diary does. We don't work with other software in the sense of like, so like our bookkeeping and payroll, it's all like embedded in our platform. But if you are using Power Diary to, let's say, process transactions, and then it's like a payment processor, and it's going into your, the settlements are going into your business bank account, then that's something that we would be able to like manage from like the income tracking standpoint. But I don't know enough about this to really know, how we'd work with it. We don't integrate with other software currently. Victoria, how much do you need to put in IRA to make up Social Security benefits lost? Ooh, this is a complicated one. Sarah, can you share the article on Social Security and S Corps? This question comes up sometimes where, because you're paying less than Social Security taxes, people are worried, oh, well, doesn't that mean my Social Security is going to get decreased? Yeah, like there could be a slight decrease in your Social Security benefits, but if you are rolling your tax savings into retirement plans, right? So if you're taking the tax savings and putting it into like a solo 401k or a SEP IRA, whatever loss you're taking on your Social Security benefits are going to be not, that they will not match the gain you will get in those putting your tax savings into a retirement plan. I mean, they're like exponentially different because of the way Social Security is calculated. So I asked Sarah to put an article in the chat. Here it is. So this article goes in depth about how Social Security is calculated, and it's specifically about S Corp and Social Security benefits. So Victoria, I would recommend you read this article because I think when you see the way that Social Security is calculated, and that it's not calculated the way that I think all think it's calculated, where we're like, well, I made $100,000, so X percentage is going to Social Security, and I'm going to get X percentage of that later in life. That's not how it works. It's actually very complicated. So I recommend reading this for anyone who is like, yeah, but how will this affect my Social Security later? The TLDR is, could there be a slight decrease to your Social Security benefits? Yes. If you were to take $15,000 in tax savings and roll that into a retirement account for 25, 30 years, would that decrease in your Social Security benefits impact you? No, because you are now taking all this extra money you have, and the rate of return on those accounts are so much higher than whatever you're losing. Deep D, can one hire people for their company, hourly, part-time, full-time as S Corp? Yes, you can have other employees as an S Corp. You can do, just like you can have other employees, you can have 1099 contractors, you can do all of that as the S Corp. You just have to make sure that you are one of those employees. Kara, if you have an LLC, do you have to make a certain amount to pay your kids for your business? Sarah, can you put our kids article, if you should pay your kids in your business article, in the chat? So if you have an LLC, there can sometimes be benefits to hiring your children. It's less based on how much you're making and more based on what you're paying your kids themselves. I recommend you read this article. One of the things I do want to point out, though, is that as an S Corp, you lose a lot of the benefits of hiring your kids. So if you are thinking about hiring your kids and you want to be an S Corp, it's not going to benefit you. So yeah, Sarah just put that blog in the blog in the chat. This one's really good too. It goes over what it looks like for an S Corp owner and what it looks like for everyone else, and how as an S Corp owner, you actually are going to lose, you're not going to benefit from it because of there's some rules around S Corps not being able to take advantage of some of the advantages of this essentially. So it doesn't really make sense. And also just to point out, like with hiring your kids, you do need to be extremely careful that you are really paying them a real wage, and that they're doing real work in your business, because this can get abused. Latanya, will I have access to the collective platform? You absolutely would. So as a member, you have a dashboard login and you can log in and access the platform. Will I be able to log in and view information and pull reports like I can with QuickBooks? Yes, you will be able to do all of that. So basically, when you log into your collective dashboard, there's a little accounting tab and you click on that tab, and that's going to take you into the dashboard, into your accounting like hub. And you'll be able to pull reports just like QuickBooks. You'll also be able to see like on like the home of the accounting hub, similar to QuickBooks, where it has those little tiles that's like, here's your profit, here's your expenses, like things like that. We have that as well. So it operates in a very similar way, with the added benefit of you not having to actually do the bookkeeping. Jessica, can you hire contractors as an S Corp, or would everyone have to be a payroll employee? No, you can hire contractors as an S Corp. You can hire employees as an S Corp. You know, there's no rules changing what you can and can't do in terms of like contractors or employees. Latanya, does the payroll component provide automated employee onboarding? Is there a limit on monthly payroll runs? So I can't remember if we do automated payroll employee onboarding, Latanya. That would be a question to ask your tax advisor if you're going to schedule a call. There is no limit on monthly payroll runs, so you can run payroll for yourself as many times as you would want to. Ramesh, I have an LLC and did not make any profits. My expenses were almost equivalent to the income or more. I decided not to take a salary. Is that okay? Well, if you have an LLC without the S Corp election, you're actually not required to take a salary. You can do whatever you want. So yeah, that's totally fine. Now let's talk about a situation that you have an LLC that's taxed as an S Corp. And let's say, in what it sounds like it's happening to you is that you are, that basically what's happening to you is that you are breaking even in your business. So you know, maybe had some income, but had some expenses and you just broke even. If you are not profitable, it's not reasonable for you to pay yourself a salary. So in this situation, it's fine. That is like the one kind of caveat to the you must pay yourself a reasonable compensation thing, is like if your business is taking a loss or you're not profitable, like you just break even or have like $100 in profit, then it's not a reasonable expectation to pay yourself. So that's kind of like, we have to think about it being reasonable. Like the key word here is reasonable. Is it reasonable if you are, you know, have a $10,000 loss that you're also going to pay yourself a $60,000 salary? It's not, right? Just like it's not reasonable if you have $300,000 in profit that you pay yourself a $1,000 salary. So it's really like thinking about what is a reasonable expectation for you and your business. Okay, another one from Ramesh. In a single member LLC, can I have my family be working on the LLC and may not be taking salary yet, being a new business? So we talked a bit about the salary thing. I would recommend you read this article about hiring your children. It's the same thing. The other one, maybe Sarah, can we share the one about hiring your spouse or having your spouse added to your business as well? Because you say family, I don't know which family you're talking about, but we also have an article about considerations about adding your spouse to your LLC. So you may want to read both of these because I think they'll cover it fully for you. Sarah, is this being recorded? It is, and you will receive the replay within 24 hours. Kara, how do you know when it's time to go from sole proprietor to an S Corp? Is there a certain amount of income you need, like 60,000 for LLC? No, it's a great question. Or to a corp. Okay, not a corp, an S Corp. So if you want to go from a sole proprietor to a corp, I would say that like if you want to do like a C Corp tax structure, you want to think about a couple things. First, you want to think about where you're taking your business. Like, are you going to need outside investors? Like, are you going to do like a VC route? Because if you are, frankly, like you are probably going to you're going to want to set that up like that way from the start because you're trying to get investors. So that's one thing to consider is like what is really like the future of your business. It's not all just like how much money you're making. Some of it also has to do with like where do you see your business going. So that's one thing. Like if you're trying to figure out like LLC or corporation or C Corp tax structure, generally speaking, like if you are seeing your business getting to a point where you are going to be like getting like venture backed funding, then you're going to want a corporation or a C Corp. But if you're like, I'm a consultant, I'm a marketing consultant, and I am not going to be doing any of that, I'm just working for myself, then an LLC is a better fit for you. And then in terms of like, maybe you have an LLC and you're like, okay, do I want to do S Corp tax treatment or C Corp tax treatment? C Corp tax treatment really doesn't come into play until you're getting much higher up in the six-figure range, like 800 to $1 million in profit. Profit, not revenue, profit. I just want to reiterate that, profit. A lot of people get this confused. I had a client once who told me, I don't need to know anything about my business. I make $1 million in revenue, but that was not his profit, right? So profit, we're talking about profit. Anonymous, would S Corp be useful for a physician who has a permanent job and do locums on the side? It will be over 60K. It could be. Yeah. I mean, the S Corp is beneficial for those who really the S Corp, you're looking at it from like a tax savings perspective. And the main thing you're looking at is like, will I save money on taxes with this thing? So yes, I will caution though, that I don't know, like as a physician, I actually don't know what the LLCUMs are, but one thing that just to keep in mind is that certain professions are sometimes required to form different types of entities. And again, it's by state, so I can't tell you what exactly you can or can't form, but some states require that physicians form like what's it called? A professional LLC, a PLLC, or a professional corp, a PC. So just want to throw that out there that it isn't not all states allow physicians and people in medical fields or accountants or lawyers, various professions. Not all states allow them to just form an LLC. Sarah, maybe we can put I think it's like LLC versus PLLC versus PC article in the chat that goes deeper into professional LLCs and professional corps. Tina, if you start an LLC, are you able to change the business name and maintain the same LLC or just update it? Yes, you can change the business name. You can also DBA, which basically means that it's like called doing business as. So what you could do is you could keep your LLC, like let's say my LLC is like Andy Smiles LLC, but now I want to go by Magic Sparkle Pony LLC. Or I want my business to be called Magic Sparkle Pony, and I want people to be able to write checks to Magic Sparkle Pony. Then I could do a DBA where my LLC is still named Andy Smiles LLC, but everything kind of like public facing is Magic Sparkle Pony, which could be a simpler process than trying to like fully change the name of an LLC. It's called a DBA, or doing business as. Amanda, can I benefit from making the switch any time of year if a quarterly thing based on my own timeline or our IRS timeline or something else? Okay, let's talk about when to make the switch. This is a great question. Okay, so you can make the switch any time of year if you are an existing, well, really you can do it any time of year. If you are an existing, if you're existing LLC, then the IRS enables you to basically backdate it 75 days. Now, I'll let you in on a little secret for those of you, 33 of you who have like stayed late. Collective has a special process for LLCs that we can backdate it further back. So if you were to join Collective by June 30th, that's our cutoff date, we can actually backdate your LLC to S Corp tax status into the beginning of the year. You have to be an existing LLC for this. We don't talk about it a lot right now because it's not really as relevant, but let's say, Amanda, you're like, I want to do this, but like, I kind of want to wait till May. It's just like I want to make sure I have the money. And, you're just like, I just want to wait till May. If you were waiting until May and you join Collective and you have an existing LLC, we would be able to backdate it to the beginning of the year. So you can join at any time, or you can switch to the S election at any time, but it doesn't mean that you are just automatically going to get the full year. So let's say you did this, let's say you decided to elect for S Corp tax treatment in September. By the IRS rules, you could go back, to like mid-July, but you would still be missing out on like half a year of tax savings. So you can make the election at any point, but it doesn't mean that you get it for the whole year. So it's important distinction, because people often think, well, I can do it at any time, and they think that applies back for the whole tax year. With the IRS, it only applies back 75 days. Again, with Collective, we have like a special process that we go through that we can sometimes backdate it further. So, but you have to be the LLC. If you are not an LLC and you're a sole proprietor and you were to start your LLC on September 1st and you're like, great, I want to be an S Corp, you're only going to be able to be an S Corp from September 1st. There's no extra backdating. Because you as a sole proprietor that you were previously, you don't have the right to that tax election. So having the LLC, I mentioned this earlier in the Q&A, having the LLC really, really helps you with having that adaptability and flexibility if your business just takes off. Jess, is there a recommended time of year to elect for S Corp? I just talked about this. You just mentioned something about being able to backdate 75 days if the LLC is already in place. I think I've talked about this. One thing I will say though, in terms of recommended time of year, obviously because we're in the beginning part of the year, the earlier in the year, the better, because you also are going to be changing a lot of your financial processes, and it's just easier for you to do that in the beginning of the year. I'll also say, speak towards the tail end of the year, like November or December. Generally speaking, especially if you're not already an LLC, let's say your LLC, you start your LLC on the 15th of November. You're kind of it doesn't really make sense to try to be an S Corp for 6 weeks, because the tax complexities that are involved with that, having to pay for this extra tax return, plus you have to do all of your previous taxes as a sole proprietor, it's just going to get messy and expensive. So in the later part of the year, you probably just want to think about starting fresh on January 1st. So it's I always think about after November 1st, just plan for a January 1st start date. And then anything before November 1st, kind of think about your timing and how far back you can go. Kara, thank you. My client is here with me and I had her listen in. I'm sending her your name and info. Great. Yes, please send her over. Really, really happy that you watched it together. I love that. Jess, last question. If you have the 2 businesses that you're considering moving to S Corp, would a membership needed for each business? Yes. So, well, in most cases, yes, because you would need an LLC for each business unless the business activities can be under the same business activity code. So for example, let's say you are a marketing consultant and you want to start doing marketing classes, online courses. You don't need 2 LLCs for that because it kind of all falls under the same business activity code. But let's say you are a marketing consultant and you also have a dog training business. There's no way that those have related business activities, right? They're just too disparate. So those you would need 2 different LLCs. And then yes, you would need 2 collective memberships. We did it, everybody. Awesome. Well, thank you all. I'm going to stop sharing my screen. Let's see what's going on. Okay, well, I don't know. I can't find the button right now. Pause share. Nope. Okay. Well, I can't find the button to stop sharing my screen. I swear I do these all the time and I do know how to use a computer, but I don't know what's going on with oh, there it is. There we go. Okay, thank you all so much for staying late through the Q&A. I'm so happy that everyone hopefully got some information out of this. And like I said, whether you're like, yes, an S Corp is for me, I'm not sure, or it isn't for me, and you just wanted the information so you have it in the future. In any case, we're so happy that you stayed with us. And we hope that you will schedule a call with one of our tax advisors. Again, it's completely free. And I hope to see some of you as a collective member. Thank you all. Bye.